Welcome and thank you for joining the Nest Egg Show today. I'm Jonna Hudson and I am hosting the show. Peggy is at an investor event and not able to make it today. Today we have Nathan Turner. Nathan is owner and president of Ernest Incorporated. He started investing in the U.S. real estate market in 2008. He started by creating notes and eventually evolved to buying performing and non-performing notes well below market value. He has been involved in all facets of note business over the years. One of Nathan's favorite things about the note business is helping struggling homeowners either by modifying their loan or making it disappear. After having been involved in the business for several years, Nathan now works with accredited investors to buy notes. He is also the host of the Diversified Mortgage Expo, where everyone from newbies to experts can come together to discuss, learn, and have fun. Having studied business management at the University of Lethbridge and working part-time in construction and painting, Nathan put the two together to start Flipping Fantastic as a home flipper. Flipping Fantastic has evolved into Ernest Inc., working in various aspects of real estate over the years. Nathan now concentrates on purchasing non-performing notes in the U.S. Doing this allows him to have much more flexibility by owning the paper and not the house. Nathan can effectively control the house without ever owning the real estate. Thank you, Nathan.
Hey, my pleasure. Thank you. That's going back a little ways. I need to update some of that information, I guess. Very good. Well, do you want me just to start and go ahead with what I've got today?
Yeah, if you would do that. We've got people coming in. I'll keep admitting them as you go ahead and share your screen and have a way at it.
All right, sounds good. All right, so I should be able to see that. So yeah, my name is Nathan Turner. I put together this presentation today about called Good Deal Detector. And this one is all about being able to recognize good seller finance deals. I've been working a lot with people that are selling seller finance notes lately and noticing that there are some things, it just seems like a lot of the seller finance people aren't really aware of what note investors are looking for. So I put this together to help that make a little more sense for everybody. So let's check it out. So Nathan Turner, a little introduction to myself beyond what Jonna said. I got started in 2008 and I was doing seller finance deals. So I was buying property back when property was dirt cheap with everything that was crashing all around us, mostly in the Columbus, Ohio market, and then started selling those houses on terms. So in Ohio, it's called a land contract. Other states, it's called a contract for deed. Other states, it's called a bond for deed or an agreement for deed. Really, just for simplicity, we've lumped those into one category and we call them contracts for deed these days. And that's how I got started. I started buying non-performing shortly after that, and then just trying to work them out, working with the borrowers to get them paying again, or oftentimes the houses were vacant, so we'd foreclose and take back the property. And then I'd either just sell the house or again, sell it on terms and create a new note. So that I did that for a number of years. And then just a few months back, we opened up a fund, a 506c fund, where we are raising capital for that and going out and buying mostly performing notes. And that's a lot of fun. I really enjoy that. Last but not least thing we'll mention here is Diversified Mortgage Expo. So last year took over this conference. It's last year was the 8th annual. This year's the 9th annual. And I had the opportunity to take it over. I am a big fan of networking and just meeting people and having connections. So that was my main motivation in taking over the conference. And I just wanted to create an atmosphere where we can come and learn about notes and talk about notes and discuss, while at the same time getting to know each other and having some fun at the same time. So that's coming up May 31st, June 1st this year in Nashville, and really excited to put that on. So I wanted to go in a little bit about what a note investor is looking for. So if you are doing some creative financing, if you're doing some seller finance deals, and you're approaching a note investor, you decide you want to cash out and get some money out of that deal, that's great. Here's some things that as a note buyer, I just don't care. So things like renovations you've done to the property. In large part, it doesn't make a difference to me. Whether you've fixed up the property or not, I'm always going to be looking at that property in as-is condition. So if as-is means boarded up windows, or if it means brand new granite countertops, it really doesn't make a difference to me as long as I know what it's worth in today's condition, not an after repair value at some point. I don't really care too much about the neighborhood. Whether this is in a really nice neighborhood where white picket fences all over, great, or whether it's in some kind of really terrible neighborhood where I would never want to raise my family, it doesn't really make too much of a difference to me. Again, as long as I know that the value is there and that that house is resellable to somebody, that's fine. That's what I'm looking for. An ARV, or after repair value, like I mentioned, I'm not looking for a future value on this property. I want to know today's value in today's condition, warts and all. Rent. I am not buying a rental property. I'm buying a note. So whatever houses are renting for in the neighborhood, or whatever this house would rent for, that's great. That I guess gives us an idea of what we might be able to sell it for on terms, but ultimately it doesn't really make a difference to me what the rents are in the neighborhood. And then PITI, principal and interest, taxes and insurance. The two that I do care about are principal and interest. That's the monthly payment that I actually get to keep. The taxes and insurance, those two things are set in escrow. It's not money that I get to collect. It's money that is set aside by the servicer that is used to pay the taxes and insurance. So it never is my money. So I've had people approach me and give me a PITI number. All I really care about is the principal and interest. The tax and insurance is not a number that matters to me. So that just needs to be separated out. And a big question I get all the time where people approach me and say, hey, I've got this note for sale. What percentage of UPB are you looking for? And that, if nothing else, it's just kind of an old way of thinking. Back when everything was underwater and those values didn't matter, the price, like the house value might be, just for easy numbers, call it 100,000. The amount owing on that property might be 150,000. So back in those days, you might talk about percentage of UPB, but again, it didn't really matter. We were really looking at percentage of value in that case, but percentage of something doesn't really make sense. It really depends on what's the interest rate, where is it located, as in what state, a number of other factors that I'll get into here in a minute. But that's what I'm more interested in, not just a straight percentage of UPB. So what does matter is note numbers. So like I say, what's the interest rate? What's the term? How long is this term? Is it a 10-year note? Is it a 20-year note? Is it a 30-year note? That makes a big difference. The interest rate is a big deal. How much down payment have they put in there? What's the first date they paid? When's the last date they paid? What's their next due date? All those numbers make a difference to me. What kind of a note is it? Is it a deed of trust? Is it a mortgage? And that depends mostly on the state. Or is it a contract for deed? Or is it a lease option? Or is it a reverse mortgage? But all of those things matter. I need to know what kind of security is behind this note. And then the underwriting and the RMLO kind of go hand in hand-ish. They're two separate things, but they get lumped together often. So when the note was originated, did it go through an RMLO, a registered mortgage loan originator, or not? And that matters just in terms of compliance. And I'll go into some of those things here in just a minute. And then, like I say, the state. Is this in Texas, or is this in Ohio, or is this in Michigan, or is it in Pennsylvania? That makes a big difference. And reason being is, if I need to foreclose, if we need to go that direction, a Texas foreclosure is a lot faster than a New York foreclosure. And so I need to know that kind of thing makes a difference to me. So those are the things that I am looking at. So I'm going to go into just a couple of these a little bit more in detail, just so we can get an idea of it. So number one, I am not a bank. I am a specialty product. And when people are doing seller finance, don't try to compete with the bank. That's my number one tip. And I say that because I was in Utah last year, and there's a realtor came to a RIA meeting, and he had a property that he was selling on terms. The problem was, so a year ago, rates were around 7%, and he was saying that he was going to sell this property at 5% interest rate. And so, why would you do that? Why are you trying to compete with the bank? You're offering something where the person is not able to qualify to bank. Therefore, you should be charging a higher interest rate. There's usury laws, of course, and every state is a little bit different. The maximum amount of interest that you can charge, and that's going to be different in every state. But my advice to people that are creating notes is set the interest rate at the highest number you can. The highest number that you can according to the usury rate, and the highest number that you can according to what the borrower can afford. But that's a really big deal. So that's an important thing if you're ever creating any paper. So bigger is better. Raise it up as much as you can. The reason all that matters is because I'm looking for a specific yield target. So when I'm buying, I'm always looking for a specific yield somewhere between 12 and 15%. If you bring me a note that's written at a 5% interest rate, my discount is going to be much larger for me to get to my target yield. If you bring me a note that's written at a 10% interest rate, my discount is going to be much smaller. So you will make more money as a seller finance originator, somebody who's making paper. You'll make more money. It'll be a better quality note if you've got a higher interest rate. Okay, so another one is the unpaid principal balance. As much as the unpaid principal balance in and of itself doesn't matter, I just need to know that it's correct. And so we need to look at things like, what was the sale price of the house and how much was the down payment? Down payment for myself, I'm looking for at least a 10% down payment. I want to see that the borrower has some skin in the game. They've made a significant contribution up front so that they feel attached to the property. Using the financial calculator, you can then go in and look at it and say, okay, you plug in the term, how long, how many months this is, what's the unpaid principal balance, what's the starting balance, at what interest rate, and then you can calculate what that monthly payment would be. So it just needs to be done correctly. Again, for myself, when I'm looking at buying a note, I want to buy it at least a 75% investment to value, ITV. So throw some easy numbers out there. So say it's a $100,000 note. So let's back up. You sold the house for $110,000. You got a $10,000 down payment, and the unpaid balance of that note is now $100,000. Let's just say the value of the property is also $100,000. The most I would pay for that is $75,000. Even if you've written it at 11%, 12% interest rate, the most I'm going to pay for that is $75,000 because I need to put in a gap there. I need some equity built in. I guess it wouldn't be 75, it would be more like 80 or 85, but you get the idea. I need to build in some equity there in case of whatever. I came up through a lot of non-performing notes over the years, and I saw lots of different situations where that equity didn't exist in the very beginning. We never had any equity. So we're always buying on a percentage of the property value. So that's a piece that I've lived through, and so it's important to me. I've gone here the 80-20. It's not the 80-20 rule. That's if you're creating a note, one thing that you can do is do an 80% first and a second at 20%. So that $100,000 property, you do a first at $80,000, carry a second for 20, and then again, then I'm paying you $75,000 at least, or at best in that case, just so there's some equity in there. But that again, that's just going to be able to get you the best deal possible. So I've got, one more, the RMLO, the Registered Mortgage Loan Originator. This is a big deal, mostly just in terms of the Dodd-Frank rules that are out there. and there's all kinds of rules. We won't get too much into that, but suffice to say that it's a requirement by the federal government that says that if you're creating more than 3 notes in a year, it has to go through an RMLO so that they can give their little rubber stamp that says, yes, this is properly qualified borrower, and yes, they can pay. So yes, go ahead and create this loan. So that's a big deal. The underwriting part of it is not quite the same. Usually it's done in tandem, but the whole point of Dodd-Frank in the first place is to make sure that the borrower has the ability to repay. So this is kind of going through that process, just making sure that they meet those qualifications so that we don't have another fog the mirror lending type situation that we had back in 0506. A couple of just really quick examples, some deal or no deal. These are notes that were actually sent to me, and this was all of the information. So I wanted just to kind of go through a little bit to show what works for me, what doesn't work for me, that kind of idea. So this is the first position loan to be assigned at close of escrow, properties in Park Forest, Illinois. So 2 things I can learn right off the very top. So number 1, this is a brand new note. There's no seasoning. There have been no payments made. So that's, for me, it's not the end of the world. If it has gone through an RMLO, I'm much more confident with that note because they've been properly qualified. I don't know that in this case, and so that's a little bit of a red flag. Second red flag is it's in Illinois. Illinois is a really tough state to deal in when you're dealing with foreclosures, and Cook County is just extremely difficult to get anything done. And so that's another just red flag. Again, not necessarily a deal breaker, but it's going to reflect in my offer. Sale price in this was $130,000, down payment 10%. So the original balance $120,000. So that's less than the 10% down payment that I'm looking for. So again, it's not fantastic. Interest rates 10%. That's a good job. There's the monthly payment, and then they give me an ARV, an after repair value of $190,000. So again, great, but what's it worth today? Is it worth 130 today, or is it worth 150, or what? I can't depend on the borrower to do repairs at all, first of all, or to any kind of quality. So I just can't depend on an ARV. So that one, there's a bunch of red flags there. I would need more information at the very least before I'd be comfortable moving ahead on something like that. Here's a different one I got sent that says, it just with the email, it said there's a link for the RMLO documents. So yes, it was done with an RMLO in Florence, South Carolina. Great. I'm a big fan of South Carolina. I think they do some really nice stuff there. Sale price $90,000, down payment $10,000. So it qualifies for that 10% down. Original balance $80,000. It's 216 months, which is a little bit short at 9%, which is not bad. Monthly payment $749, and it's a brand new origination. So again, that's pretty good. I'm missing a little bit of information. Let's see, what am I missing here? That's pretty much all the information I need just to be able to make a decision. I would then go back and look at the property itself, check out the value, see what we think the house is worth, make sure there's a decent investment to value ratio on that. But that's not bad. That's kind of the basic numbers that I would need, the basic information that I would need to be able to make a decision and say yes or no. There's one more. Again, this is the information I was sent. Properties in Big Spring, Texas. I'm a fan of Texas. They are really easy to work with. Down payment $10,000, current balance $123,807, remaining term $232, interest rate 11. Great. Monthly payment there and date of first payment. So that's pretty good, but I'm kind of lazy. So you're making me do some work here. So I just threw this in here just so this is some of the other information that I would need. If you could just give me that information up front, that's even better, just because you're making me do math. That's hard. Come on, just give me a break. So the sale price, if I kind of reverse engineer it a little bit, sales price on this was actually $135, original balance $125, original term was $240. So it's not quite the 10% down. It looks like it does have a little bit of seasoning on that, about a year, which is great. That's a good interest rate on there. So this one's decent. I would want to do a little bit more homework on that just to find out what the current value of the property is. just to give me an idea of what's going on with it. But just to give you a little bit of an insight onto what it is I'd be looking for and what's good, what's not good. So that's, oh, wait. That's more information that I filled in. No, that's a separate one. Oh, let's look at this one, because this is the one that I got that had way more information. So it's got sale price. It's got a down payment of 10%. Original balance, original term, interest rate. It tells me that there's no balloon. Great. It's got some seasoning I can see because it was created back in September. Current balance, appraised value from a BPO. So it gives me, like, this is great. It gives me all kinds of information. It's non-owner occupied, which is also, that's not a bad thing. It tells me it's current. Payer's occupation, I don't usually get that information, but that's good. Commercial construction business owner. So that I can kind of guess there is non-owner occupied. So it sounds like this is maybe somebody that owns a business and they've rented out the property or something like that. Dealing with, just as a bit of an aside, dealing with if it's B2B, so if the borrower is a business, some kind of an entity rather than a person, none of that Dodd-Frank stuff applies. So that's kind of a plus. That's kind of nice. Just not how to deal with it. Tells me it's got a title policy and it's in Spencer, North Carolina. So this is fantastic. This is great information. This is all kinds of stuff that I would want to know before I could move ahead on it. And this one looks really good. No major issues, no major red flags. It looks pretty solid. So I would want to review all this. It doesn't say RMLO on here anywhere. So I'd want to review it. I'd want to just double check the value on it. Another thing that I check before I buy any note is title insurance, or sorry, title report, just to make sure there's no other liens out there that are outstanding that we don't know about, and just kind of check it all out, make sure it looks good. But all in all, that one looks like a pretty good deal. So that's about it. I wanted to keep it nice and short, keep it open for any questions or anything. That's me. That's my conference coming up. Like I said, May 31st, June 1st. If you're interested in notes, if you want to learn more, if you want to contact other note investors and network with other note investors, that's definitely the place to be. And then there's my email and phone number. So that's it. I kind of went quickly through it, but like I say, I just wanted to give you a brief overview of what we're doing here.
All right, thank you, Nathan. We've got a couple questions in the chat, so we'll start with those, and maybe they'll generate some more questions.
Sure.
From Patricia, what is seasoning and why is it good? Great
question. Sorry, I'm using a little bit of lingo that is not generally known. That means number of payments. So if it's got 6 months of seasoning, it means it's got salt and pepper and all the rest, but it just means it's got 6 months of regular payments.
Okay. And from Clarence, what would you pay for the property you showed in Texas?
That Big Springs one? Let's do a little bit of math. So give me 2 seconds. I'll tell you. Actually, you know what? Let's do this just for fun. I'll share my screen again. Let's go on to the calculator. So here's what we've got. We've got unpaid balance, 123,807. We've got interest rate of 11%, 232 payments left. That gives us, our payment amount matches, so that's good. Well, first things first, now we know the numbers match, so that's good news. All things being equal, let's say that there is proper value there and everything else. At minimum, I'm looking for a 12% yield. In this case, I did look at this a little bit. Big Spring is in a little bit of a smaller, it's a bit of a smaller town, which for me is not ideal. I like at least 20,000 people in there, but more is better. And again, if I need to take the property back, it gives me some security to know that there's a healthy real estate market. I have a better chance of reselling the house. So I would just say, I would probably quote this at about a 13% yield, which means I would pay roughly 109,000. And if you don't know the calculator, that's okay, but that's just super fast demonstration of how I would look at that and what I would be looking at to make that decision.
Clarence, do you have any more questions about that, why he's got the calculations up?
Not about that, but I have a couple more questions when it
Sure.
comes. Is it time? I mean, should I ask now? On
Sure.
property number 3, you mentioned that you didn't have to concern yourself with Dodd-Frank. Why was that?
Property number 3. 1, 2. There's the last one there, payer occupation, commercial construction business owner. So I'm guessing, I don't know exactly on this. I would want to look at the paperwork. If the borrower is an entity, so it's an LLC or an LP or something like that, in that case, Dodd-Frank rules do not apply. So if it's a business that owns the property and that's the borrower, then we don't have to worry about that.
Thank you. Do you have to worry about usury in that case?
Yes, but it's different again. For businesses, the usury is a different number than it would be for a consumer.
Thank you.
You bet.
In another situation, well, I think you're mentioning that you deal a lot with seller created notes,
Yes.
but then you're also talking about having a preference for loans that are the RMLO standards.
Yes.
How many seller originated loans, I mean, are to RMLO standards?
A lot. Thankfully, it's been something that so there's a lot of gurus out there, and they're not necessarily teaching the RMLO concept that exists, and that's something that needs to be looked out for. So 2 things. Number 1, there's been an increased push in educating those that are creating notes that yes, this is the law and you have to follow it. Second of all, if they haven't, most things can be fixed. Most paperwork issues, and I would include this in that category, most of the time that can be fixed. If they've already been in the house and they haven't gone through the process, there's a pretty good chance they already qualify. They just didn't get the rubber stamp. If for some reason they don't qualify, it's a case by case. We can either just pass on that loan and not buy it, or we can work with them to see what we can do to maybe modify the loan where it might fit their income situation and get them into a place where they would qualify. So there's a couple of different ways we can approach that. But that's been the increased push, is like, yes, this is important. Yes, you actually need to do this. It does matter. So that's been working. We've seen a lot of people that are coming around to that idea.
How can you tell if a loan is RMLO?
Anytime I'm looking at a loan, I get to see all the paperwork before I buy it. So it's right there in the paperwork. It'll most people would keep it as a separate folder that has the RMLO documents.
Do you pass if it's not RMLO?
Not necessarily, but we'll look at it more closely. We'll look at how they qualified that borrower. If it just so happens that they would qualify, but they didn't go through an RMLO, that's something I'd probably still buy. I would probably discount it a little bit more, because then I'm going to have to go back, spend some time and money going through the RMLO to get that certification. But like I say, it's a case-by-case basis.
Thanks.
You bet.
Jamila. Is that how you say your name?
Did you say Jamila?
Yes.
Okay, yeah, Jamila. Hi. So I have a situation where what if you own the house outright, and that you had a tenant in there that totally trashed the place to the point you have to tear up stuff. How do you go about evaluating how much to put the pricing at?
Oh, that's never happened to me. Never. Yeah. No, you can either you can fix up the property, go in there and make repairs and whatever, and then sell it as, whatever the value would be repaired, or you can sell it as is with repairs needed and charge a little bit lower price or a little bit lower monthly payment to give some leeway for the people to fix it up themselves. I've done both.
Right.
Um,
As is, how do you put the pricing structure?
Yeah, you can do it. So in that case, if I was going to just sell it as is and have the borrower be the one fixing it up,
Yep.
first of all, again, depending on the state, but more than likely, I would set it up as a contract for deed. So in that situation, in case people don't know what that is, I own the property and the borrower is buying it on terms. So they're making regular monthly payments, principal and interest. Once all the payments are made, that's when title changes hands.
Like rent to own.
Yeah, sort of. Yeah. Rent to own, except it's a principal and interest payment instead of rent, but similar idea. Yeah.
And then how again do you price it?
Worst case, I would get a local realtor to come and look at it and give me their thoughts. I'm always remote. I live in Canada. Everything I buy is in the US. So I rely on local professionals, people that can actually look at the property rather than me.
Okay. All right. Thank you and then we can reach out to you for personal stuff.
Yeah, definitely.
Awesome. Thank you so much.
Yeah.
And Patricia had a clarifying, you had asked on the seasoning. What is seasoning? And you answered that, and she wanted to clarify. So it's that the buyer has established some credit with the purchase, and they are more likely to finish paying for it. So your investment is more secure.
It's kind of that, Newton's laws. Something in motion tends to stay in motion. Something in rest tends to stay at rest. It's kind of that same idea. If they've been making payments, they're more likely to continue to make payments. If they are not making payments, they're less likely to make payments.
Okay, I have some questions. Not
Sure.
Everybody else is. So notes are just basically a written promise to pay, right? One person promises to pay the other. So
In essence, yeah.
Who buys notes? I'm guessing the answer is anyone can, but who buys notes? How do they do it? Why do they do it as opposed to the bank? And where do they do it? Do they call you? What do they do?
So there's a couple of things in there. So essentially it's a promise to pay that you're taking over. So instead of the person, so let's say I sold a house and sold it on terms so that I'm collecting payment. Really what it comes down to is the reason why I would want to sell that is because I would rather have a lump sum of cash today than multiple payments over time. So I would rather collect, even if it's a discount. So let's say the unpaid balance is $100,000. I'm okay collecting $80,000 today versus waiting to collect that $100,000 plus interest over the next 20 years. So that's essentially why somebody would want to sell it, whether that's an individual or a bank. Banks, really, it's the same thing. They just want the cash. So that's why. Well, what else did you ask? Why would you buy them?
Where do you buy them? How do you go about doing that?
So it's a fairly small community. It's not really mainstream, I would say. My experience, and shameless plug or not, but my experience is going to conferences. And I went to my very first note conference in 2009, and I was the Canadian guy. So that helped me kind of stick out a little bit, I think, in a good way, I hope. And I just started buying notes from, talking to people that were at the conference. And so, are you selling anything, or what kind of notes are you selling? And just kind of started with that, and networking, talking to the right people. There's a really good online sellers platform, I guess you would call it, called PaperStack. That's stack with no C and with no K on the end, just STAC. And that's a great one where anybody who owns a note that wants to sell it can list it. PaperStack just gets a fee when the transaction takes place, but otherwise they're not making any other money off of that. They're just transactional. But it's a pretty great place to go, and they do a really good job of walking both sides through the process. And again, I'm not getting paid for this, but they do a really great job of it, where the buyer does this, now the seller does this, and it just kind of walks you through the entire process. So at the very least, you've got the paperwork correct. Whether or not it's a good deal, that's a different question. And that's kind of up to the individual as well. But that would be another place where you can go to buy some. My caution with that is, just because you've done real estate does not mean that you know notes. This is finance. This is not necessarily real estate. Ideally, we never want to own the real estate. Ideally, the real estate is nothing more than just security behind the paper. So it's a bit of a different game, and you need to learn the rules. I don't teach it, but I can point you in the direction of people that would be happy to teach you the business. But does that answer all your questions?
No, but Doug's got some comments. Doug, are you able to come off mute?
Yeah, this is Dylan, not Doug. I can't change my name.
Okay.
But what's up?
Did you want to share what you were saying in the comments and have a little discussion on that?
Oh, I was just stating to be very careful with notes. It got wrapped up towards the bottom by Nathan there, but notes can be very dangerous, and so.
Yeah, it's not a get rich quick, and it's not a guarantee. Yes, you can lose money buying notes. Absolutely. So you can't just jump into it.
I trade swaps, forwards, and I trade swaps and forwards all day. So trust me, it's a much different game.
Yeah.
Nathan, do you ever buy notes from? I'm sorry, Doug, say that again. Or Dylan, can you say that again?
Sorry, my service is bad. I trade a lot of swaps and forwards, and derivatives contracts on public markets. So do a lot of due diligence on it, what the collateral is, and then how that collateral is moving, and what the risks are underlying that collateral. Whereas in private parties, notes, or swaps, whatever we're transacting here, but we'll keep it simple at notes. They're private party, so the amount of public information you have to do due diligence on is a lot more limited, and it's not audited. It's not. They could make anything up in the world. So not only do you have that risk, but your notes are also an internally leveraged product as well. So there's a lot that goes into it.
Dylan, just to clarify, are you talking about notes as in trading, or are you talking about real estate backed mortgages?
Both.
Okay.
I mean, we can do MBSs, we can do interest rate swaps. I mean, any of it really. It's all kind of the same fundamentally. Yeah.
Part of the reason I like real estate notes is because it is backed by the real estate, and there's generally more information available on those than on some of the other trades that are being made. Generally.
Yeah, if you can get an ISDA and go trade public swaps on real estate, MBS's interest rate swaps as a hedge against that, or what, however you want to structure that trade, it's great. Private market's a little different, but yes, I would tend to agree that it's better to buy a note or a swap on real estate than, an oil mine or oil well.
Yes. Yeah.
Doesn't mean it's safe or not risky. It's just better
Yeah.
from a risk perspective.
Yeah, for sure.
So Nathan, do you ever buy notes from the bank?
Uh,
Non-performing notes?
indirectly, yes. I haven't for a little while, mostly when I was buying from, and let me explain that first. So indirectly, because generally banks are going to sell in large pools. So they'll sell 500 million at a time. My fund's not that big. It's just a $5 million fund. So buying directly from the bank is a lot more difficult unless you've got a really deep pockets and you've got different kinds of connections. Then I would buy from some of these larger hedge funds. So they would then buy these large pools from the bank and then go through the list and say, okay, we don't want anything outside of this box or whatever that box looks like, different states, different property values, different whatever, income ratios, whatever, however they want to split that up. And then they say, okay, anything outside of this box, we're selling off. So that's how I would buy, like I say, indirectly from the banks. For me, that was mostly with non-performers. With the performing notes, especially recently, the notes that were all refinanced early in the pandemic at 3%, those are really difficult for me to buy because I'm looking for that higher yield and my discount's just going to be too big and we're going to be too far apart on our numbers.
Okay. Any more questions?
What are you seeing as your
Go ahead,
average
Doug.
delta spread?
What am I seeing is what, sorry?
Your average spread or your average delta on these notes?
So the notes themselves, I'll put it this way. So like I say, I'm looking for a yield target somewhere between 12 and 15%. And then it's just going to depend on what deal we can work out on the purchase side. And like I say, a higher interest rate note, something that's at 9 or 10% is going to be a lot easier for me to purchase.
Right. You guys run into duration at all trading these?
Duration, no.
Okay.
So Nathan, you have a fund, a note fund. Do you want to talk about that a little bit?
Sure.
Is it open now? Are you taking funds in? What kind of returns? Just curious on, I've never looked at note funds.
Sure. Yeah. So it's a 506c fund. So open to accredited investors. Minimum investment's 50,000. And because we're buying performing notes, they're secured by real estate. I'm using the words carefully so my lawyer doesn't get upset with me, but secured by real estate and a safer investment, I can say that. So because of all those factors, we're offering an 8% return and we do quarterly distributions. Minimum investment's 50,000, maximum's $1 million. And like I say, it's a $5 million fund, which is small enough that I don't have to open a big office and large enough that I get a good pay from that as well.
Nice. Okay. Anybody else? Jamila, you still have your hand up, but is that from before?
Yeah, that's from before. Sorry about that.
Okay. Does anybody else have any questions? Comments? Experience? Anybody with experience buying notes and as an investment?
I have a couple questions for Nathan.
Sure.
Nathan, on your fund, does that fund buy notes from you?
Does the fund buy notes from me? That's a great
Yes.
question. No. I would like it to be the other way around. My whole goal in setting up the fund, well, not the whole goal, but a major goal for me is as the fund buys notes, it's a 5-year term on the fund. At the end of that term, I would like to buy most, if not all of those notes into my personal portfolio. So I would like to buy from the fund, but no, the fund doesn't buy from me.
So are you going to be able to buy from the fund?
At the end of the term,
Yes,
me personally,
yes.
yep, I can.
Is there any predetermined price? Or is that irrelevant because the investors just get 8%? And beyond that, they have no concern.
That's it. The investor gets the 8%, and then that's what they get. So I'll buy in order to get my investor's money back for sure. After that, though, that's it.
How do you get paid while this fund is ongoing?
So that's a great question. So the investor gets paid out the 8%. Anything over and above that, that's what I get paid.
Well, thank you.
You bet.
We're approaching the top of the hour. I'm going to shut off the recording and